I wrote an estimate last month for $18,000. The homeowner's check came back for $14,000. $4,000 of her money missing. She called me confused and a little bit angry. Here's what I told her at her kitchen table. There is one rule buried at the end of a claim like hers. It decides whether she gets 3 of those $4,000 back, and almost nobody explains it to homeowners up front. By the end of this video, you will know that rule cold. I am a field adjuster. This is the job on a real house. Call her Karen. It is not her real name. A wind and hailstorm rolled through her neighborhood in March. Her roof was 12 years old, shingles original to the house. I climbed up, walked the slopes, and found the damage. Enough hail hits to justify a full replacement. I wrote the estimate that afternoon at her kitchen table. $18,000, full roof, gutters, a little flashing work. She looked at that number and thought the check was coming. It was not that simple. Almost nobody's is. Every property policy pays one of 2 ways. The first is actual cash value. We shorten it to ACV. That is what your damaged roof was worth the day it broke. Worth today, used up years and all, not worth new. The second way is replacement cost value, or RCV. That pays what it actually costs to put a new roof up. Same hail, same 12-year-old shingles, 2 very different checks. So the very first question I ask on any roof claim is this. Which one did you buy? Karen had replacement cost? Depreciation sounds like an accounting trick. It is not. Think of it as age, nothing more complicated than that. A shingle roof is generally built to last 20 years. Karen's roof had already lived 12 of those 20. 12 years of shingle life already spent before the hail ever fell. The carrier will not pay her for years she already got. That single idea explains almost every number in her claim. So watch what happens to her $18,000. Start with the full estimate, $18,000 on paper. First, we subtract depreciation for those 12 spent years. On a roof like hers, that usually lands between $2,000 and $4,000. It is not pure math. There is judgment sitting inside that number. Hold back too much, and she cannot afford to start the work. For Karen's roof, I landed on $3,000. Then her deductible comes out. Hers was the median, $1,000. $18,000 minus $3,000 minus $1,000. $14,000. That is the check that confused her. Nothing here was denied or hidden. It was subtracted in the open. Here is what most homeowners never learn at this point. That $3,000 held back is not gone. It is waiting. We call it recoverable depreciation, and the name is literal. The carrier is not keeping it for themselves. They are holding it until Karen proves she replaced that roof. Take the smaller check and never do the work. You keep the smaller check. Do the work, prove it, and the rest comes back to you. For Karen, that is $3,000 sitting behind paperwork. People walk away from that money constantly. Now here's something that surprises almost everyone. A roof carries more depreciation than the inside of a house. Not because roofs matter less, because of how people actually live. Interior finishes get refreshed, new paint, new flooring, new cabinets. That work is cheap and easy compared to a full roof. So the inside of most houses runs younger than the roof above it. Nobody replaces shingles because they got bored of the color. A roof sits out of sight, quietly aging until a storm finds it. Picture Karen's neighbor, same street, a different kind of loss. A supply line lets go upstairs in the middle of the night. Water drops through the ceiling and ruins the drywall and floor below. That estimate comes to $6,000. But her flooring only went in 4 years ago. 4 years into a 20-year life is barely a scratch. So her depreciation is small, call it $900. $6,000 minus $900 minus her $1,000 deductible. $4,100 lands on her first check. Same city, same week, wildly different math. 12 years spent on a roof against 4 years spent on a floor. That gap is depreciation, doing exactly what it was built to do. Now back to Karen and the rule I promised at the start. Getting the held back money is unglamorous. It is also simple. Finish the roof, then send the carrier 2 things. Pictures of the completed work and the final invoice. Not the estimate, the invoice, what actually left her account. And here's the part that catches people out every time. To recover the full holdback, that invoice has to reach the replacement cost value. Say her estimate was $18,000 and her contractor does it for $15,000. She does not collect the difference in cash. She gets made whole, not better off. That is the deal. If the real cost comes in higher, that is usually a supplement. Document it, send it in, and it gets added to the file. A claim is not closed when a check arrives. It is closed when the work is done and the invoice matches. People ask me how long they have to claim that held back money. In practice, There is usually no hard deadline on the recovery itself. But file the original claim fast. Within about 30 days is the habit. Get the roof finished as soon as the schedule realistically allows. A big job takes time and nobody expects it in a week. What causes real trouble is a claim left open for a year. Memories fade, contractors move on, proving the loss gets harder. Karen's roof got done in 6 weeks, invoice sent, holdback released. Sometimes that depreciation is never coming back and you need to know it. If your policy pays actual cash value only, there is no holdback. That smaller first check is the entire settlement. The clearest example is a DP1 policy, actual cash value only. On most other forms, an older roof is not treated differently in kind. More depreciation just comes off the top, same formula either way. None of that is hidden. It sits on your declarations page. Read it before you have a claim, not after the storm. If you live near the coast, there is a layer under all of this. In a lot of coastal counties, wind and hail is not on your homeowner's policy. It is carved out and written through a state-backed association instead. In North Carolina, those are the Joint Underwriting Association and the Insurance Underwriting Association. People just call them the Fair Plan and the Beach Plan. So a coastal homeowner is often carrying 2 policies, not 1. That choice decides where a shingle claim even starts. Wind or hail damage starts with the association, not your homeowner's carrier. Filing against the wrong policy rarely loses the claim outright. It costs you time, and time is not free either. Now here's the part that changes Karen's numbers completely. For a named storm, that deductible is a percentage of your dwelling limit. Not a flat amount, a percentage, typically 1 or 2%. A named storm means the thing had an actual name on it. So the $1,000 from earlier stops applying entirely. Run Karen's roof again on the coast after a named storm. Same $18,000 estimate, same 12-year-old shingles. Depreciation is still about $3,000. But 2% of a $400,000 dwelling is $8,000. $18,000 minus $3,000 minus $8,000. $7,000 on the first check, not 14, not 10. Same house, same hail. A different deductible line did all of that. At 1%, it would be $4,000 and her check would be $11,000. One line in a declarations page moved her outcome by thousands. On the coast, that deductible is not a small detail. It is often the single largest number in the whole claim. Learn it before the storm, not while standing in the yard after. There is also wind-driven rain on a standard homeowner's form. Wind has to create an opening first before that water counts. If rain enters through an opening that was already there, that is different. Something like the main electrical line entering the house. That is generally handled as water damage, not as a wind claim. That is its own episode and it is coming soon. Everything in this video still applies underneath it. ACV, RCV, the holdback, the invoice. It just applies to whichever policy actually answers the call. So, before anything gets damaged, learn 4 things about your own policy. 1. Does it pay actual cash value or replacement cost? 2. What is your deductible and is wind and hail written separately? 3. How long do you have to finish repairs and claim the holdback? 4. How old is your roof, honestly, not the year you assume? Those 4 decide almost everything a claim will feel like. They take about 10 minutes to look up. Karen looked hers up after the fact. You do not have to. I am a field adjuster. I write claims like this every week. This channel covers the mechanics, not advice on your specific policy. Read your own declarations page and ask your own adjuster your own questions. Next episode is about the $20 part that prevents a ceiling claim. That one is going to annoy some people.